Hello and welcome to another edition of the Up Your Assets podcast. My name is Ray Ferrara, CFP, founder and executive chair of Provise Management Group, LLC in Clearwater, Florida. Our podcasts are educational in nature and not designed for personalized advice. Please speak with your financial advisor, attorney, or CPA before making any financial moves. Additionally, no guest on our podcast pays to be on the show. We do not endorse any products or services, and the opinions expressed by our guests are clearly their own and not necessarily those of Up Your Assets. Longevity is one of the most important and challenging factors in retirement planning. The longer people live, the more their financial, health, and lifestyle needs must be stretched across a long time period. A retirement lasting 25 to 35 years is no longer unusual. Retirees must ensure their assets last through potentially 3 decades of non-working life. All of this starts with a good savings ethic early in life. Even then, if spending isn't carefully managed or investment returns are lower than expected, assets can be depleted too early. One of the major expenses, which is often overlooked, is the cost of health care. Even with Medicare in the United States, retirees face premiums, deductibles, and out-of-pocket costs. The likelihood of needing nursing home, assisted living, or in-home care increases with age, as do the cost. These expenses can be substantial and are often not covered by Medicare. Over decades, inflation significantly reduces the purchasing power of pensions, Social Security, or conservative investments like bonds. At only a 2.5% rate of inflation, things will cost 28% more in 10 years, 64% more in 20, and 110% more in 30. Retirees must balance safety with growth, often maintaining some exposure to equities and other inflation-sensitive assets. Longer lifespans make delaying Social Security more valuable as larger benefits continue for life. Retirees can't afford to be overly conservative at the start of retirement. Poor market returns early in retirements combined with withdrawals can severely damage a portfolio that must last for decades. Assets may be consumed by living expenses and healthcare costs. Longer retirement benefits mean wealth transfer may happen later, sometimes when heirs are already retired themselves. Longer lifespans encourage part-time work or consulting to bridge the gap. Retirement often includes an active phase, travel, hobbies, higher spending, followed by a slower phase, lower spending, but higher health care costs. Longevity amplifies every risk in retirement. Market risk, inflation, health care, and withdrawal strategies. Successful planning requires balancing guaranteed income, Social Security, pensions, annuities, with growth investments, flexible spending, strategies, and protection against health care and long-term care costs. In short, retirement planning is more complicated than most believe it is. To help us understand some of these complexities, our guest today is my longtime and good friend, Rick Kahler. He holds multiple credentials, including an MS, CFP, and CFT. He is president of Kahler Financial Group, which he founded in 1981. He became the first certified financial planner in South Dakota to be fee-only in 1983. In 2020, he became one of the first certified financial therapists in the nation and a certified internal financial systems financial therapy practitioner in 2021. Rick received the Insiders Forum Iconoclast Award for his groundbreaking work in financial therapy. In 2017 and again in 2019, Investopedia.com named Rick one of the top 100 most influential financial advisors. He has co-authored 6 books on the psychology of money. Rick has been a columnist for 32 years for several South Dakota newspapers and is the author of many articles and white papers and launched his own podcast in 2021. He's been published and quoted in the Wall Street Journal, the New York Times, the Washington Post, CNBC, and Forbes, just to name a few. Rick, welcome to Up Your Assets.
Great to be with you, Ray. I was thinking on a couple of those accolades that I was just right behind you.
Well, thank you. That's very kind of you. I appreciate it. It's been a great run for both of us, and it's always fun to catch up with longtime friends. I never refer to old friends, only longtime friends.
Long time, yeah. That's more important framing at our long time age.
That certainly is. Well, Rick, the certified financial planner designation is pretty well known credential, but tell us a little more about the certified financial therapist designation.
Now, the certified financial therapist designation is probably at the same point as it was 40 years ago when we were working to get the certified financial planning designation known. And this is the designation that's pretty new. To your point, I'm one of the first four, I think, in the nation to get that. And basically, it's a combination of financial planning and behavioral change or mental health competencies. So, a certified financial therapist is trying to help people change their money behaviors, looking at the root of the behavior, money scripts, the trauma, family systems, and emotions that drive decisions. We know that the research shows 80 to 100% of all financial decisions are made emotionally. And this is what really got my attention back in 1999 was that I had better learn something about how the brain operates or I would be irrelevant as a financial planner. Little did I know the path that would lead me down. So this particular designation comes with ethics and education so that I can talk about basis points and withdrawal rates and all the nuts and bolts of planning. But I'm equally fluent in what's happening inside the brain, what's happening emotionally when money gets hard, and especially when people get stuck around money decisions. I used to think all I needed to do was maybe raise my voice and they get it. That doesn't work so good. There's a whole new level of competency that financial planners are needing, and it's going to become more important to have in the future. Back when you and I were trying to get the CFP to become more recognized, it was a different game. We were looking at the fact that investments were going to become commoditized. Today, financial planning itself is on its way to being commoditized. So we've got to ask ourselves, especially if you're a financial planning professional, what's next? What's left? And what's left is the relationship. You and I have known that for 20 years or so. But broadly speaking, most financial planners don't recognize that yet. I know the folks we associate with do, but I teach a course at Golden Gate University, and I'm just shocked at how many students, most of whom are financial planners, in that course have never heard of financial life planning or the intersection of money and emotion.
There's no question that the emotions around money and the conversations around money are equally as difficult, if not more difficult, than those conversations around sex. And we've certainly experienced that as we've gone through it. And feel really good that you and I, along with a lot of Nasrudin friends, that's an organization that you and I belong to, that really got together early on to deal with the money issues and the emotions around it. So, Rick, let me ask you, with our clients, we usually plan for them to live until 95 and often 100. The common refrain is, Ray, I'm not going to live that long, so why are you doing that? What do you share when you hear from your clients that statement, Rick, I'm not going to live to 100?
Yeah, I'd like to tell them we're not predicting your exact age. We want to manage the risk of outliving your money. And for a healthy 65-year-old couple, it's a coin flip if one of those spouses is going to reach 90. So planning to 95 to 100 is prudent. It's not optimistic. And there's some research out that says it takes about 15 years for the general public to assimilate new research, new data. And the data certainly is showing that we're more and more of us are living well into our 90s. So our brains will default to the availability heuristic, which we picture relatives who died younger and maybe friends or folks we've known. And we use that to estimate our own odds. And so that's why it's a good thing for planners to lean on actuarial data and build in some margin. And that's it's easier to overshoot it than to undershoot it.
Yes,
And
it
most
sure is.
clients frame that way will say, yeah, you got a point there.
You know, when we're doing our planning, we try to do it in a very conservative way, and certainly stretching life expectancy is one way. If it's going to last for 100 or 95, then it's certainly going to last for anything less than that. Yeah, I try to remind clients that the fastest percentage-wise growing cohort in America today is those that are turning age 100 and becoming a century of age. And within my own family, I had a dad that lived to 93, an aunt that lived to 95, a grandmother that lived to 99, another aunt that lived to 100, and I want to set a new record for the family.
You bring out a good point because in my family, nobody made it out of the 80s.
Wow.
I think 85 was the record, except my mom just died last year at 95, and my dad is 95. So they have blown away both families' longevity ages. And I think that's a case in point that just because everybody in the family died at this age does not mean that's going to be the same for you.
Absolutely. Well, you know, given that many of us have better lifestyles than our parents did. Just think of smoking. The percentage of people smoking today significantly lower than it was when we were growing up as kids. You look at lifestyles beyond that, and then you look at what medicine has been able to do and what the future might. It gives a lot of hope and a lot of promise at the same time.
Exactly. And a lot of challenge to us as planners.
Exactly. Well, let's first focus on some of the psychological aspects that often misinform us. First, let's talk about availability bias. Exactly what is it, and how does it affect you with your planning?
Yes, I referred to that this is where we put more weight on what is easiest to recall. So we use the example of when relatives have died and we apply that to us. Whereas if the last thing that we saw was a market downturn headline, we might assume that market downturns are normal. Certainly, I think of my kids and I have told them since 2016 that a lot of what we see in the world and the way the country's run, et cetera, is very abnormal. Today, that I was using availability, and today abnormality is completely normal to them. Like, what are you talking about, Dad?
Of course. Well, you know, I'm basically an optimistic person, so I've got to admit I have an optimistic bias. But help us understand the difference between that optimism and pessimism bias that exists so much.
Yeah, this is a big one because optimism bias is just that we overestimate positive outcomes. I mean, it can be anything, but the one I see a lot is that the money will always be there and the money will show up. And it's nice to have that optimism, but it doesn't always happen. I have one client that has that bias. It has worked. Money literally comes from nowhere from other countries. But by and large, the optimism bias can get us into trouble without really taking a look at both sides of the coin, which I would frame as more reality.
Well, I think it's always good to be optimistic. I think at the end of the day, I just expect things are eventually going to work out and work out for the better. Obviously, it doesn't happen all the time, but I like to.
That's good news for you because optimists live longer.
Well, that is, I did not know that. So I'm going to even get more optimistic.
Research.
Good. So maybe that gives me a chance for my present bias then. So when you think of present bias, it's really the shorter term events are more important than something in the future. Help us understand that a little better.
Yeah, with the present bias, we assume the present is going to continue to be the future. This is a big one for retirees and one that can keep them from planning for retirement because the spending, what I have noticed is that the spending continues at the same level when retirement happens. For people that haven't done any planning, that can be a big detriment because in a year or two, things can be setting into where they start getting concerned that maybe they're overspending their retirement income. So that's where the present bias can really bite somebody in retirement. It also can show up in saving. Well, saving feels harder than spending because today is more important than tomorrow. And we just assume tomorrow will be look just like today, which you could bring in some optimism bias on that too.
Indeed. And how about the anchoring effect? Here in Florida, we do a lot of fishing, and I know that the kind of anchoring you're talking about is a little different than what we would be using here on the boat. What does that effect look like?
This is a big one. We see this heuristic all the time. I see it in me quite often. And that's where we rely too heavily on the first piece of information we hear. And in, say, for example, with market, we may anchor on the highest level that our portfolio was at. And then we have a little present bias to that to assume that that level is going to continue. Well, the market takes a downturn. The average bear market finds stocks falling by 42%. And we anchor on what we have lost rather than anchor, 20 years ago, this portfolio was much, much less. And even taking away the fall in the market, I'm still at 8% a year average return. The brain doesn't tend to like to think that way. It looks at that one data point, and then it can also distort future decisions because we're so anchored on that price. I used to be in real estate, and the same thing would be when a person lists their property at one price. We can anchor on that price and not be able to adapt to the fact that maybe it was listed too high. And we can be chasing the market down as offers come in that are less. Anchoring effect can really cost us a lot of money.
It sure can. And I laugh when I say this, but I shouldn't be because we all do it. And that is whatever that high water mark is for that investment portfolio, that becomes the new baseline. It's like I'm starting all over again and it can't ever go below that amount. Well, how about status quo bias?
Yeah, we with this one we avoid change even when change might help. So in investments, it can keep us stuck in an old investment or a certain stock that maybe we have emotional tie to, or we've just always had it, or spending habits that this is just the way it is. This is my habit. I am a routine guy. So I can get stuck in status quo bias really easy.
So let's shift gears for a moment. The markets have always been volatile, but seem to be more so in the current world. No one worries about volatility when the market's going up, only when it's headed down. A major risk for those entering retirement is the sequence of return risk. Please explain what it is and how you deal with it with your clients and help them when they do retire. And that does happen, that the market goes down first rather than go up.
Yeah. And this is one of the most significant risk for retirees that is a real technical risk. It's real hard to avoid that timing. And as you explained, if the market drops early in retirement, like you retired today, I remember back in 2000, I had a client retire. It was March of 2000 or April that things didn't do good, and they retired at the beginning of 2000, and the market just tanked. So that's when you're just beginning the withdrawals. You don't have the safety of your earned income anymore, and your portfolio might never fully recover. The volatility isn't itself the danger, but it's when that happens and the timing, and depending on, if you're withdrawing out of a portfolio that's on the way down, you just may never make that up. So I think it's a pretty easy thing to guard against. And the biggest thing that we do is have 1 to 5 years of retirement income in cash.
Absolutely.
And you've heard the same thing from an investor who despises cash because of the low returns and that you can do better in the market. Now, we haven't seen that in the last few years, but we certainly saw it in the 20 years prior to that. And I want my money working. I want it in the market. And I like to tell them that don't think of cash as an investment. Think of it as insurance. And we want to ensure 1 to 5 years of income, because usually if you go 5 years, most bear markets are overdone and recovered in 5 years. Quite frankly, 2 years is probably more. And so this can really insulate that portfolio from having to draw on it at precisely the right time. And I find that most clients really understand and embrace that when it's explained.
And it's great to hear you say that, because that's exactly where we are talking about it, like being insurance. The only other thing that I would add to what you just said is that in that insurance, if you will think of it that way, whatever that insurance is, that's off the table, and that's not the part of the portfolio from which you can draw, nor the percentage of the portfolio. So in the case that you talked about, let's suppose it's $100,000 a year for 3 years, and it's $1 million portfolio. So I've got 300,000 sitting on the side. Whatever the withdrawal I'm going to make is going to be on 700,000. It's not going to be on $1 million, because I've got to protect that when the market goes down, I can start using that cash and let that 700,000 have a chance to recover.
Absolutely. And something else that could be factored in here is the timing of Social Security. We know that the numbers suggest waiting until 70, but that can help add to the cash flow, to the longevity risk.
Exactly. Well, in creating a retirement plan, since we were just talking about withdrawing from a portfolio, what do you consider a safe withdrawal rate each year when you're chatting with your clients?
Well, that's there's been a lot of different opinions on that over the years. I would say historically, 3 to 4% is the rule of thumb starting points. I've heard some radio personalities recommend 8%.
So I really need to find out that person that can recommend that and do it with a good conscience.
Well, this works because that person that I'm referring to says you can get 12% in good growth mutual funds. Well, if you can get 12% and you spend 8, that means you're leaving 4 to compensate for inflation. That works. I mean, that's the methodology. You want to leave enough in the portfolio to compensate for inflation. The problem that both you and I know is you're not going to get 12%. And anybody that's followed this gentleman's advice here, I did some a market analysis on that, and most people would run out of money in 10 years following that advice, because we know that diversified portfolios return about 5% a year or 6% a year. So if you're withdrawing 3%, you're earning 6, at least 3% in for inflation, which has been close to the long-term inflation. And that's what we're trying to do here. So, of course, the answer is the less you can withdraw, the longer it's going to last. 2% is better than 3%. But if you're looking at withdrawing 5%, you're starting to get into the area where you may outlive, but it's not guaranteed. It just depends how many years. I don't know. 5% Ray, 20 or 25 years might be who ran the numbers, how long the money might last.
Yeah. And the other thing is as I try to chat with folks as they're approaching or are in retirement, is you took all of this risk as you invested your money in those formative years while you're working, and and you did that because it gave added value to your life. You could buy that second home, you could buy that big boat, you could educate your children, all of those things. You took that risk and it added value to your life. Now that you're retired, what's the difference between earning 6% or 8% or this magic 12% if it adds no value to your life whatsoever? Why take the risk in the first place?
Exactly. And to your point, we'll do the numbers on a portfolio. And quite frankly, they could have, let's just say they could be a 20/80 portfolio. And they've been an 80/20 investor all their life. That psychologically can be so hard to make that switch because the brain is saying, wait a minute, I'm leaving all sorts of money on the table. There's going to be less there, say, for my heirs, which is true, theoretically. But sometimes it's so hard for the brain to make that switch to go from a saver investor to a spender consumer. And that's one of the hardest things for money vigilant folks to make, to flip that frugal switch and become a spender and realize I have enough.
So let's go to that is enough, because one of the big questions or one of the big fears is, Ray, I don't want to run out of money. I don't want to be dependent on the kids. And it's a huge fear as they no longer get that paycheck every 2 weeks anymore. And they start taking money out of the portfolio and instead of adding to the portfolio. The one thing I try to tell clients is my experience is that most people don't run out of money. What ends up happening is the money goes down. They begin to pare back on their lifestyle. Now, go back to 2008, 2009, perhaps is the most recent example. If you're a member at 3 country clubs scattered across the United States, you pare it back down to 1. If you're used to taking 4 vacations a year, you pare it down to 2. You don't go out to dinner to eat as much. And therefore, you actually should have a fear of losing your lifestyle more than running out of money. But how do you help people overcome that fear?
I completely agree with you. You just don't keep the foot on the gas pedal spending and go over the cliff. We adjust lifestyle before that. And there's a number of ways to address longevity concerns. Social Security is the big one. Maybe not for every client, but for most clients, it's important, and it's inflation adjusted, which is really an important feature of it. As I talked about before, delaying to 70 is important. And the big thing that I hear around Social Security is fear that it's going to be there. There's so much misinformation regurgitated by politicians around Social Security, the fact it's going to run out of money in 20, I think they backed it off to 2032 now, which isn't true. The money's there. Taxes are in place to fund 70, 80% of it. It's a political third rail. I am not concerned about a Social Security disappearing. So that's important. Then there's annuities, which the annuity to me is a 4-letter word because most of them have high fees. There is an annuity use that makes sense called an immediate annuity. And these are not very popular. I can count on one hand the number of times I've recommended them, and no client has ever followed through and purchased it. And again, we can get into heuristics on this because once you buy an immediate annuity, the money's gone. The income stream is there. I mean, there's all sorts of variations of this where there can be some money, but in theory and practicality, the money's gone when you die. And this is so hard for us to get our head around. It feels like a loss aversion, a heuristic. I've lost my money. Well, I've gained a guaranteed income. So in theory, these things can work really well when we're putting together our financial plans, but the emotional component of an immediate annuity is just huge.
Well, I couldn't agree with you more on the annuities. It drives me nuts. Those Sunday morning TV shows where people are selling these fixed annuities that have high commissions, high fees attached to them. It's a travesty, in my opinion. But the products are out there. People don't understand the complexities that are involved. If they are thinking about buying an annuity, they really should seek a second opinion somewhere else just to confirm their decision.
Absolutely.
So, Rick, living longer comes with risks around health. And one of those are mental health, and particularly around dementia. And you probably don't know this, but my wife has Alzheimer's and Parkinson's disease, a battle we've been fighting for 11 or 12 years, 12 years now. And when we're working with clients as an advisor, how do you address this with a client when you suspect that their acuity may not be what it once was, and then also, how do you factor this into your longevity planning in the retirement planning process if you do that at all?
Yeah. First, I just want to say, Ray, that I'm so sorry.
Yeah, thank you.
That I did not know that, and that's a tough lift. It's a tough lift for both your wife that has it and for you, and especially becoming more and more of a caretaker. My mother had dementia, and my father-in-law died of Lewy body dementia,
Mm.
which is it's pretty ugly, and it's just everywhere. It's so very common. So it's a big deal. And in planning for it, we like to plan for at least 2 years of assisted living, skilled nursing with every client. And if dementia is really runs in the family, you could make an argument for planning for a little bit longer, maybe 3, 4, 5 years of assisted living or skilled nursing. So baking it into self-insuring into the plan can be a great thing. Now, the question is, that's going to reduce current spending. Baking that in means you're going to spend less today. Some plans can do that. Some plans, it can be a problem. Of course, you have long-term care insurance that can or can't be something, but that's the financial side of it. Probably the harder side of it is just the emotional side of it and the behavioral side of it, because so many clients, and I've written on this in columns, don't know what's happening to them, and that's where we try to have trusted contact agreements in place. That when we see somebody starting to fail, I remember I had one client, a couple, and they went into dementia together. I mean, they both were failing at the same rate, which is not common. So you need to have trusted contact for sure. Trusted contact arrangements where the planner has permission to call someone close to the client to say, "Hey, this is what I am seeing." Of course, durable power of attorneys are important. Trying to make things as simple as possible is important. You can automate bill pays. You can have two-factor authentication on things. You can have dual approvals for large disbursements where somebody else has to be agreeing to that. But it's a fine balance because the person needs to be able to accept the fact they're in decline. And many clients sometimes want to keep that spending close, get concerned about a family member being involved. So often what we see is without a real good intervention is that by the time the client can acknowledge that, they're almost past the place of acknowledging it. And then you get into if you have springing powers of attorney, you have physicians that have to agree they're not capable. Well, that can be really hard to get. What looks to be not capable to you as an observer may still be capable to a medical professional or a court, which is one reason that I prefer to have powers of attorney active rather than springing. So those are just some of the things that come to mind.
So, in that regard, if there is a blessing about Alzheimer's, is that most people who have the disease don't realize that they have the disease. And when Kim was diagnosed early on, had a wonderful neurologist that we were working with, good friend. And Stu said to me one day, he said, Ray, he said, you need to understand that the brain protects itself by not remembering it can't remember. And I shook my head and I said, Stu, you got to explain that to me. And what he said well, think of a time when you couldn't remember a name, where you put the keys, the tickets for the show, and it drives you nuts. And I said, well, of course it does. And he says, well, just imagine if all you could remember is you couldn't remember 24/7 and you had that anxiety your entire time. And so the brain protects itself by not remembering it can't remember. Powerful
Wow.
way to explain it to people and the repetition that comes with it.
That is really powerful. I have never heard it framed that way.
So even those without dementia are susceptible as we age, not being quite as quick as we once were, and particularly to scams. In fact, last year, according to the FBI, seniors lost somewhere around $4.8 billion. Phone scams, lover scams, email scams, on and on. How do you deal with that with your clients for them to protect themselves, even though they don't have dementia, but they're just not as fast as they once were?
Yeah, this is a tough one. We've had clients scammed. It's real. It's happening a lot. And so it's really important that we as planners are looking out. And this is where a person needs to have an advocate in their life, somebody who is looking out for them. I once asked a friend of ours who's very interested in senior planning, how do you make it in this medical system? And I was just talking about the medical system without an advocate. What happens if you don't have an advocate? And he just said, you die. And I think the same thing is true financially. And this sounds so self-serving, right? We get somebody through retirement, we get them through those crucial ages of 70 and 73, and when the RMDs are happening and Social Security's coming in, and let's just say they're at 75, and the planning seems to be in order. And they will say, well, I think I can do this by myself now. And I get horrified because one of the biggest values of having a trusted financial professional in your life is being able to watch for those red flags, sudden large withdrawals, changes to ownership or beneficiary, maybe a new family member or friend that is becoming overly involved, shifting behavioral keys, that somebody that's very passive is getting very aggressive, very angry. All of these things an involved financial professional can see. And that is so important because it's so hard for us to see, especially in the early time of this. But again, dementia aside, just the scamming and having that relationship that you can call up. We had a client that had the grandson, a scam pulled on them, and grandson needed money, and she was calling us in about the middle of this for more money. We didn't know what was going on. And we were able to put a stop to it immediately. That is so important. We talked about the trusted contact form, which is pretty important to have. Um, Sometimes we will get agreements where we can also contact accountants, attorneys, bankers. We can widen that loop, get information, shut down things, and be as proactive as we possibly can. The best thing that we can do is to alert our clients of all the scams that are out there.
It's absolutely true. We've had them over the years, but it's terrible. But what we have found is the biggest abusers happen to be family members or very close friends, people they thought they could trust, who then end up taking advantage of grandma or grandpa, as you mentioned, the grandson situation. So it's just something to look out for.
That, when you say that, I think immediately of 3 or 4 clients where the kids got involved and the kids had no idea of the planning that had been done. And there's often a kid that thinks they know more about investments and investing than we do. And we have seen some terrible things done to clients because of a child, and a child that knew just enough to be dangerous. And this is so important that a person is aware of this and has things constructed to protect themselves. You can put things into trust and do things where your trusted financial advisor can remain the investment advisor. You can bring kids in earlier rather than later to get them educated and start to build the trust with the financial advisor. Because I think oftentimes we're viewed as the financial advisor that's selling the annuities, and they project that onto us, and all of a sudden we have an adversarial relationship.
So, Rick, as we wrap this up, and I thank you, what last words, if any, do you have around the longevity issue? What would you like to share as that last little nugget to be taken away?
Yeah, I think the most important thing is to understand that retirement is a huge transition, probably one of the biggest ones that we make in our life. And doing it both with financial awareness and emotional awareness is highly important. And it's that emotional awareness component that often gets swept under the rug. Doing the work on why I might have resistance to planning to live longer, looking at these heuristics, looking at my financial history, my financial emotional history, and doing that work to thrive in retirement. Because one of the big problems with retirement is depression. And so we need to pay attention to both our financial health and our emotional health to really make the most of our retirement year.
Well, Rick, thank you. It's been a great session. I hope that our listeners will be able to take a few nuggets themselves away from our conversation. Clearly, for me, for us not having seen each other for a number of years, this has been such a pleasure, and I want to thank you very, very much.
Yeah, thank you so much, Ray.
And now I want to remind all of our listeners, go out there and up your assets.